Stablecoins look simple. One digital token, one stable value. The policy challenge is harder. A redeemable token can start to behave like money. In this module, we use the Stable Act to examine where stablecoin issuers should fit in the regulatory system. So far, we've moved from broad regulatory uncertainty to specific proposals for digital asset markets. Clarity addressed market structure and agency roles. Genius focused on stablecoin issuance and reserves. Stable narrows the lens further, asking how closely stablecoin issuers should be supervised when their products function like money. The Stable Act matters because it treats stablecoins less like a tech product and more like a money instrument. If a coin is used for payments, savings, or settlement, policymakers ask a basic question: what happens if confidence breaks? That concern leads to 4 risk areas: issuer solvency, reserve quality, redemption reliability, and spillover into the wider financial system. The Act's stricter posture is designed to pull those risks toward bank-style oversight. For executives, the takeaway is strategic. Regulation may not just add compliance cost. It can determine which stablecoin business models are viable at scale. The banking perimeter is the line regulators draw around activities that can create bank-like risk. Inside that line, firms face licensing, capital, liquidity, examinations, and consumer protection requirements because customers are trusting them with money-like claims. Stablecoin issuers sit in the gray zone. They may not make loans like banks, but they accept funds, issue redeemable tokens, and manage reserves. The policy question is whether those activities require full bank supervision or a lighter framework that still prevents runs, reserve failures, and consumer harm. Under the Stable Act, the core issue is the redemption promise. A stablecoin issuer is not only providing software, it is promising that digital tokens can be exchanged for real value. As more people rely on that promise, the issuer starts to resemble a money institution. Bank-like treatment means approval before issuance, ongoing supervision, strong reserves, capital expectations, audits, and clear redemption duties. The goal is preventive. Ensure issuers can withstand stress, protect users, and avoid failures that spread beyond one platform. A stablecoin issuer's license is not just a legal wrapper. It shapes the entire business model. A bank charter brings the strongest prudential oversight and may build trust, but it also means heavier supervision, higher costs, and slower launch. A payment company license fits everyday transaction use cases and can move faster, but may leave regulators concerned about reserve quality and run risk. A specialized issuer regime tries to split the difference, with stablecoin-specific reserve rules, clearer consumer protections, and less burden than full banking regulation. That choice directly affects strategy. Prudential risk starts with a simple promise. One token can be redeemed for 1 unit of currency. That promise only holds if reserves are real, liquid, high quality, and easy to verify. When users doubt the reserve mix, the issuer's solvency, or the speed of redemption concern can quickly become withdrawal pressure. The issuer may then need to sell assets fast, creating losses and deepening the DPEG. Regulation tries to interrupt this chain with reserve standards, disclosures, liquidity planning, and supervision before confidence turns into a run. As stablecoin issuers become more institution-like, regulators will expect more than proof of reserves. They will look for a complete risk framework. Capital buffers help absorb losses from fraud, cyber incidents, operational failures, or reserve mistakes. Liquidity planning shows the issuer can meet redemptions in calm markets and under stress. Governance and compliance make accountability real through board oversight, internal controls, audits, and independent review. For executives, the key point is cultural. Regulatory readiness is not a legal add-on. It becomes a core capability for operating a trusted stablecoin business. Financial crime compliance is not a single check at account opening. It is a control system that follows the stablecoin through its life cycle. Onboarding and KYC establish who the customer is. Wallet screening helps identify sanctioned addresses or high-risk counterparties. As transfers occur, monitoring looks for unusual velocity, structuring, risky jurisdictions, or patterns that do not match the customer profile. When alerts appear, teams escalate, investigate, report when required, and remediate weaknesses. The stakes are high. Weak controls can trigger enforcement, loss of banking access, and reputational harm. Reserve backing is only one part of a trustworthy stablecoin. The issuer also needs controls around every system that can move value, change records, or interrupt service. That includes custody arrangements for reserve assets, strong private key management for token operations, and strict access controls across treasury and technology platforms. It also means planning for failure, cyber attacks, vendor outages, smart contract issues, and disaster recovery events. Regulators increasingly expect these controls to be documented, tested, audited, and owned by accountable teams. Operational resilience is the proof that the stablecoin can keep functioning under stress. Trust also depends on transparency. Issuers need to show what reserves are, how liquid they are, where they are held, and whether maturities match redemption needs. Regular attestations or audits add credibility, though the strength of those reviews can differ by jurisdiction. Governance is the control layer. Independent oversight, conflict management, and written reserve policies help prevent risky decisions. When reporting is clear and consistent, users, partners, investors, and regulators can judge redemption strength before stress appears, reducing the chance of panic withdrawals. Stricter issuer rules change the business model, not just the legal checklist. Compliance teams, audits, reporting, and supervision all add recurring cost, which pressures margins, especially for smaller issuers. Reserve limits can also reduce interest income, so profitability can no longer depend on chasing yield. At the same time, regulated banking, custody, and payment partners become essential gateways to customers and institutions. The result is a more selective market. Firms with strong controls may gain trust and access, while weaker issuers are pushed toward exit, merger, or niche roles. The Stable Act debate is also a strategy question. How fast can you launch, and how durable is the model once regulators, banks, and institutions start paying attention? A lighter posture can help a product reach market quickly and capture liquidity early, but it can also leave more uncertainty, especially around enforcement and partner risk. A bank-like or supervised model may slow deployment, yet it can create trust that compounds over time. The strongest teams design compliance scalability from day one, so speed, liquidity, trust, and regulatory alignment reinforce each other. Executives should treat stablecoin strategy as a sequencing decision, not just a technology decision. First, define the role: issue, distribute, integrate, or supply infrastructure. Then choose the regulatory path: direct license, regulated partner, or defer until rules mature. Next, test the operating model against the hard requirements: reserves, custody, AML, sanction screening, reporting, governance, and incident response. Finally, align the product roadmap with customer demand and risk appetite. A practical outcome is a status for each area: ready, build, partner, or defer. That turns uncertainty into a manageable executive decision process. To wrap up, the Stable Act treats redeemable stablecoins as money-like instruments that may belong inside the banking perimeter. That brings serious compliance expectations: AML, sanctions, monitoring, custody, reserves, and governance. These duties do more than add paperwork. They change margins, partners, launch timelines, and defensibility. Next, we use this foundation to evaluate stablecoin business models and product strategy.